So David Solomon at Goldman Sachs, probably a little bit more cautious. John Williams says everything's all good. Which is it in your mind, Jeff?
Tom, I think I'm in the middle. I'm certainly not going to argue with the grand poobah of Goldman, but I am constructive on the market here. And I know you guys took one on the chin for the Yankees last night, but let's stick with the baseball analogy as we have World Series. And I think the Bears, all these Bears are kind of scratching their head, and they're wondering why the S&P 500 is back up at 3,000. But I think there's three reasons, three strikes, if you will, why these Bears are going to be out. First and foremost, we're seeing a nice earnings season. We're seeing earnings season beat expectations. I know the bar has been lowered, but by and large, it's nice to see the banks really result. Secondly, we are seeing Fed policy at the end of the month. We're expecting the CME Fed Watch tool. It's an 85% chance that we're going to cut rates once again. And I think the third and final reason is the fact that we have a U.S. trade tariff conversation or a deal, an imminent deal. And if we see that really come to fruition, I think we take out those all-time highs we just had in July.
So Jeff, there's been a concern right now that the leadership position, the leadership vanguard, if you will, for the market has been, technology type companies, communication services type companies. And those are the ones that are not exactly leading the way higher this time around. It's more of these defensive names, dividend payers, that sort of thing. Is that a real cause for concern right now, that we don't have the traditional leadership in this market?
Well, Dom, I think it's a new paradigm shift. All of a sudden, we're seeing utilities. We're seeing TLT, which is obviously the 10-year note proxy for the ETF. You're seeing a lot of people going into different areas they typically don't in a up market. So right now, technology continues to be number one on our relative strength matrix. It's been number one for 2 years, Dom. So as we see that surpassing the S&P 500 year to date, we're sticking with these themes. However, it does make sense to have a little bit of defensive. Maybe you start equal weighting your basket, maybe you trim and book some profits, because when you see that global growth number specifically coming out of China, that GDP number, the lowest in 30 years, that is for reason for concern. But the one thing I go back to, and the floors here in Chicago don't lie, Dom, it's price. And the S&P 500 price nearing 3,000 is really interesting to see, because the market is being supported by the Fed, by earnings, and also this U.S. China trade tariff conversation. So there's a lot of momentum. I don't know how long it can be sustained at these new all-time highs, but right now, short term, Dom, I'm constructive.
Short term, there is momentum, but if we're showing a chart right now of technology, we've shown a chart of the S&P 500. We've been in what traders call a consolidation type phase now for months at this point. We haven't really broken out to the bottom or to the top. What exactly then does it take, I guess, to break the markets out of this range and either get towards record highs or fall off towards those correction type levels?
Well, you bring up a great point, and yes, we have been range-bound most of 2019. We've been back and filling in the S&P 500 from 2,800 all the way up to 3,000. But I think one thing we've talked a lot about here on Worldwide Exchange is the U.S. dollar. We're seeing the U.S. dollar back down at October 2018 levels, trying to get back under 97. That weakening dollar is supportive of U.S. equities. There's no mistake about it. When you see that dollar on purpose moving back lower, staying stagnant, that is going to be a wind sail for all U.S. equities. But it's interesting to see, Dom, just a couple weeks ago when we saw that U.S. dollar kind of above 99, people really had a breath of, they had a little caution in their lungs. That air came in. Whoa, what happened? Now, sure enough, the U.S. dollar has dropped, and here we are, 1% away from all-time highs. The U.S. dollar is driving the boat.
All right, Jeff Kilburg, live in Chicago. Thank you very much for those market thoughts, and have a great Friday.